Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 11th, 2022. It's 11:32 a.m. Eastern Time as I'm starting the video, and I'm just going to do an update here for you on the equity markets, and just going to touch on the three core things that I've been focusing on, my core holdings and things I've been talking about the most, and that's the equity markets, short equities. And again, I'm speaking trend, what's looking out going forward, weeks to months. Short equities, long gold and silver, and for the most part, those are the core things there. And I'll do an update on Treasury bonds that I showed you. Did a video on that yesterday. But let's start out here. I'm going to start out with the short-term charts this time. I usually start out covering the markets with the weekly or daily charts. This is a very short term. Yesterday I told you I was going to roll my futures contracts on the NQ, and this is the new June contract right here, and it looks similar. I'll show you the March contracts for those of you still in that. And even if you don't trade futures, this is just as relevant. This is QQQ. Effectively, this is QQQ. It's the same index. You just have this is the Globex trades. These trade virtually around the clock, so you can glean more clues from the charts, more technicals. You see more levels that you don't see on QQQ, and you're looking at a security that's trading from 9:30 a.m. to 4 p.m. Whereas this is again shuts down a little each day, just at the end of the day, and then opens back up and trades almost around the clock up until tonight. Of course, futures will shut down after the close on Friday. A little while longer, they continue to trade for a little longer than the market, and then they open back up Sunday night. So here's what I'm looking at. We had a trend line right here off the recent lows that was taken out today. There was a pop. I mean, this is ridiculous. I saw the headline this morning. Putin kind of indicated, if somewhat, that there's progress in talks with Ukraine. I mean, it was first of all, if anybody in this world is a known liar, it's Vladimir Putin. And so the algos bought it, individuals bought. I don't know what happened, but it was a spike, a big spike too. Percentage wise, if you're for the futures, you can see that was. Measure it out here is better than 1.5%, close to 2%, but completely faded. It started fading just before the open, and then when the market opened, and I always say that don't put too much weighting into what happens in the pre-market session, because you have all the it's kind of a lot of the second stringers out, warming up, playing on the field. And then at 9:30 a.m., the big boys, the starters, step onto the field. That's institutions, and they just sold the snot out of that pop. And so what we're looking at here, and I'm going to get the 60-minute charts, but on this 5-minute chart, I'm going to bring it in a little tighter for you, like this. You had that impulsive drop down. You hit this trend line, and they bought it, and they bounced. As usually when you fall that much down to a trend line, that was probably a almost 3% probably drop off the highs this morning. You're going to get at least a little kickback. And what you did there is you flagged. Look at that. You hit it and put in this little bear flag type action. Then you went on and broke it down. You broke down below the trend line. So I just want to say that this is very near term, but it plays into what I'm about to get to. I'm going to walk out to the weekly charts and tell you what I'm looking for, and then what if we see, depending on what happens today by the close, it's going to either give us any additional check marks for the bearish case or additional check marks for the bullish case, or maybe it'll be a non-event. I'll talk on that in a second. I just wanted to show you short-term charts. Little divergence here right now, working on that 5-minute chart, so maybe that flag won't play to its measured target. Maybe it will. Let me just zoom back out. You can see the levels, and I don't want to spend too much time on it there, but there's a reaction, previous reaction low. So these are the little micro things I'm looking for. They're not the be-all end-all, but remember, I told you had the makings of a very near-term, short-term uptrend recently with higher highs right here, and then lower lows down here. And so boom, we took out that one. So again, this is just a little play calling here. You don't long-term traders certainly, or regular swing and trend traders, shouldn't read too much into this, but the more check marks you get, then took out that previous reaction low, and if you take out this previous reaction low right here, then you get another check mark, and so forth and so on, and you get a huge, big old fat check mark if and when you take out those recent lows right there. So that's short-term stuff. That is, again, that's the Junes. Here's your nope, Nope, I've got the March contract still over here. Oh, this is a 60-minute. The March looks almost the same on the 5-minute. I'll show it to you there. That's it. You can see, boom, took out that uptrend line, had a few nice clean reactions, and that made a fourth reaction, validating reaction, then took it out today. So you've got some pretty decent support down here. But if you come down to this support zone, which is 13,348, we'll call it 13,350 up to about 13,380. If you do hit that, you're also going to take out this previous reaction low, unless you just bounce right on the top of it and hold that up. So again, this stuff I'll be looking for today and going forward. Now let's go back out to that 60-minute chart that I just was on, and that's kind of a little bit bigger picture stuff. If you're not an active trader, you don't do this full time, don't have the luxury or the desire to sit in front of a computer all day during trading, the trading session and game those little micro rips and dips, then this is the one I've been focused on lately. There's our downtrend line on NQ on the 60-minute chart, comes off the highs back in early January right here. So really pretty much the beginning of the year, even though we peaked, remember we peaked to the left of this, we peaked back in November. We've been stair-stepping lower, but it really started, that was almost a double top high there. So this is the intermediate term trend. Remember, long-term trend, we're still in a bull market. Even I don't care about the 20% plus drop in the NASDAQ 100. I've talked about that before. When you look at the long-term charts, a weekly, monthly chart, really off the 2008-9 lows in the NASDAQ 100, that trend's still bullish. Although I'm getting more and more trend indicators and sell signals starting to roll over. And this is the intermediate term trend, and then the very near term trend right here. So bullish long-term trend, bearish, clearly bearish intermediate term trend, which is really the most important one for swing traders. Sorry, I don't know what happened there. Let's go back to where we just were. And again, so that 5-minute chart, if you're not a very active trader, and if you don't have the experience, don't start, be careful. This is not the time to, cut your teeth on it trying to learn active trading if you don't know what you're doing. The market's so volatile. You're going to be whipsawed here and in and out. You can certainly either paper trade or take small positions, or just kind of go with the, I think it's a little easier for most to just stick with the trend and trend trade. And so what I wanted to show you there, besides the fact that we're still well below that downtrend line, and here's what we need to take out. Here's an uptrend line, a potential uptrend line off the recent lows. Once you take that out, see, this forms a triangle pattern, almost a symmetrical triangle pattern. So this is what the bears really want to see. Break down, take out the bottom of the triangle, which will also be that recent reaction or set of reaction lows, and then of course that reaction low. And then it should be, I would say the odds go up very sharply, increase very sharply, that we're going to go on and hit my next downside targets on the indexes. Likewise, bulls want to see this happen. If they pop that trend line, that's certainly not going to help the bearish case. It doesn't guarantee a move to new highs, but we'll keep the divergences intact that are on the daily time frame. And we could see anything. Anything's possible. I'll go over it. If it happens, I'll go over each and every key resistance level. I'm kind of hitting the big ones right there with these lines. But right now, again, we're not at risk of doing that, at least not at this point in time, and probably not today, which means probably not this week. I'm about to get to the weeklies in a second. What I can tell you is, I know, again, sometimes I get a lot of feedback. It's hard to see in the videos. I'm going to zoom in for you there. So what we have for the first time in a while now is my beloved negative divergence, and we're in a bearish trend. This is a 60-minute chart. This is great for the intermediate term trend, and in a bull market, I like to see positive divergence as a catalyst to go long. Even in a bear market or bear trend, you can still go long off the divergent lows, but when you get a divergent high on a 60-minute chart, I can't even remember. Let's see, when was the last time we had one? I was back here. At least, yeah, I guess that's it right there. We had that bearish rising wedge. We were already short at the time, but that was an additional sell signal right there. Boom. And, if you shorted that breakdown, it was a beautiful wedge, negative divergence confirming the wedge. And just to measure it out for you, from there, the index, the NASDAQ 100 dropped. Where's my percentage? Oh, there, it's popping up there. I'm trying to see it. It's almost 15, 14, about 14%. So this one, the divergence is about comparable. It has every bit of likelihood to play out for another 14% drop because the charts are what I call stacked right now. You take out that, and there's that little uptrend line I was showing you on the 5-minute chart. Take out the lows, go out, take out this triangle, and then voila, we're going to be looking at, which I'm going to jump over to now, my weekly chart. Before I do that, I'll just show you the 60-minute chart of QQQ. Again, same trend line I've been updating. Highlighted it as an objective short entry here and here. We had the sell signal on the PPO, then we hit the trend line rejection. And that was good for even just for an active trader. That drop from there was about 8.5%, but we're below trend, and so now a little trend line break here. We don't have to hit the trend line again. If we do, it'll be an objective short entry with a stop somewhat above or larger stops depending on what you're targeting. But the fact that we just hit it here means we may just go on down now. You can occasionally you're going to come in and check a trend line. And we just did not too long ago. And now the more significant weekly chart. We'll zoom in nice and tight and just recap. I know a lot of this is repetitive, but it bears repeating, especially for those that are just catching up. Maybe haven't watched every video this week or the last couple of weeks. But there's that big T1 level. First target was hit right here after multiple short entries from here, and all along the way down, and even on the kickback rallies. We bounced off that initial tag of T1, took it out last week, and now this week we are, barring a big reversal today, we're going to get another red close, and that's what I wanted to see. I wanted to see that to keep this potential bear flag pattern in play. There's your bear flag, there's your flagpole, the impulsive leg down, and the measured target, if hit, is going to take us closer right around my first target, around 300. It says 299.15. You can either cover a little bit above or start tightening, trail your stops down tight, because as I mentioned, the mere fact that if and when we hit my second target is going to, although it is support and a bounce is likely there on the initial tag, likely is not guaranteed, but then it's going to continue to trigger more and more longer term trend indicators rolling over from bullish to bearish and sell signals on more significant charts like the monthly chart. So anywho, that's up next, and that's kind of what I'm looking for. That we'll try to gauge if and when T2 is even hit, if what the likelihood of a bounce is based on how the short-term charts look at the time, and maybe how far. I can just say right now, if I had to take a wild guess here, again, we haven't even hit it. I don't want to get ahead of myself, but if and when we do, I still think it'll be pretty quick. And if we bounce from there, I would say another back test of that level would be ideal. Although we should be getting to that point. Once you start getting deeper and deeper into correction territory or bear market territory, you start to see selling usually will tend to accelerate as more and more long side traders are having their stop hit and they're getting margin calls from their broker, which then forces them to either sell positions, or your broker will do it for you if you don't. So anyway, first things first, and let's go back to where I started. Look at those 5-minute and 60-minute triangle patterns and recent reaction lows. And then look, the day is still young. It's not even noon yet. It's 11:45 right now. And all we know, or I can tell you right now, is if there's one thing that this market has showed us, and it's typical in any correction, is that you're going to have these wild swings, and these swings are going to measure easily 3, 4, 5, 6, 8% or more. And so anything can happen today, and that's why if anything does change significantly, I'll do an end of day update. That is. Oh, and by the way, yesterday's move, or up until this morning, the pop up today, was just a nice backfill of that gap. See the gap from the other day? That was the gap from, what date is that? Last Thursday. Boom. Gaps, that's the market likes to fill, or stocks or indexes like to backfill gaps once they're there. So there was a gap. You backfilled it. Sellers stepped in and met that gap backfill with pretty impulsive selling so far, and kind of gave you this, flagging type action. Actually, we might have met that flagpole target there. If I measure it, looks roughly about the same. And then there's, support right there, previous reaction low. So that's that. And the Nasdaq 100 is not everything, but it's the big one. It's the has the highest concentration of the market-leading FANG stocks, which are also the largest component of the S&P 500, and that's Apple, Microsoft, Alphabet, Amazon, Tesla, and the likes. And so this is what it looks like on a 5-minute chart there. And then just loop all the way back to the weekly chart. Same thing. You have so far on the weekly, you had an impulsive leg down, i.e., a flagpole right there down to the low, set up with some consolidation and a back test. That bear flag back tested the key 451 resistance, former support back here. Move down, only one green candle so far. And again, so we'll be watching this. As I like to say, the redder the better. So if we can dump today and close down at or near today's lows, or this week's lows, which are also not today's lows, but again, that was that recent low from last week right there. If we can do that, close down near or especially below that, that's just another check mark in my opinion. If they hold it up, and especially if they print a green close today, well, it shows that the momentum on the downside has slowed down. You can see, we were coming down. S&P started following the Nasdaq eventually, and it's had some impulsive selling. But you put in these divergences. This is the one thing, or the primary thing, giving me pause right now, because I'd really like to see those taken out. These positive divergences, especially with the primary trend being bullish, you have to respect them. If they play out, they could play out they could be the catalyst for a move much higher. Again, it's not my primary scenario. I'm not trying to give you wishy-washy analysis, but it's something you need to recognize because there are no guarantees. And so if my targets to the downside are not hit, the longer the market holds up here, what it does, it starts to turn up the shorter term indicators, like the on the 60-minute chart. If we have any moving averages or whatever you put up there, or the momentum indicators, that's what these are all about. The PPO, the RSI, they start to turn up when you've been in impulsive selling mode, but then the market starts to stabilize. So all right, that's it. Let's not talk anymore on it, and we'll just see where we close today. You guys know what I want, again, to increase the odds. We're going to go down further and maybe to add some short exposure. It's a weekend. I don't really, when you add on a Friday or take a new position, long or short, you have 2 extra days of overnight risk. So you can wait till Monday and maybe we gap up, maybe we gap down, but you're not risking that. So for the most part, what I'm trying to say, if you're somewhat risk averse, and you have a heavy long or a heavy short position right now, you may want to consider lightening up before the close, or wait and see what happens. If we dump into the close today, it's going to be it'll increase the odds, or it'll be a good sign for those short that we're probably going to continue down next week, and probably with a gap down open at the Monday's open. All right, gold, silver, and the rest of them. Gold, really nothing much to update. I told you I've kind of morphed into more of a trend trading mode because we had the breakout I've been waiting for above the weekly symmetrical triangle. This is GLD weekly chart. Boom, breakout. Boom, break of the 173.87 resistance above the triangle. And nothing but buying so far. And as I said the other day, just being an active trader that I am, can't help it. You hit that reaction high, had negative divergence on the 60-minute chart. So I looked for a pullback trade, which I got, but I'm back in. I've been building back into these gold and silver positions. Let me show you the futures because I don't really have this. Do I have the 60 marked up? Yeah, I do. And it's same with the 60-minute chart of the futures. There's an uptrend line comes off the early February lows right there, and you also have price support. We may hit that trend line, but we might not. This has been a powerful run. A lot of people have missed the boat. They wanted in. They didn't want to take the breakout. They've been dismissing gold, but when they see it run like that, then they want in. And so you may not get to the trend line, but if you do, it's objective. This is what I was telling you the other day. You have either price support. Let me go back to the futures. You have horizontal price support, which I mentioned, 1977 right there, which we already hit. So you've had multiple opportunities recently to get add in gold or buy it back if you took profits recently or whatever. And then if we go a little lower, then you have trendline support. So Again, this was and still is my buyback in zone for gold. And somebody had asked last week, hey Randy, I'm looking to get into gold. Can you provide objective entries? And that's what I do. So, and if I'm wrong, then you decide, and it's going to be again commensurate with where you think gold's going. If you're just looking for a run back to test that high again, you want a tight stop, not too far below the uptrend line. If you're looking for another, 20-30% plus in a bull market, and a larger bull market in gold, which I believe we're in, you can easily allow a pullback here. You can even add if we come down to that 1888 area, which is support as well, with again stop below. So again, stops are always in line with your price target. You typically, not always, but I like about a 3-to-1 risk reward ratio. So figure out how much you think gold upside, what you want to target, and same thing with the mining stocks and then silver. And I'll get to that one. So, well, let's just roll into silver now. Here's silver, 60-minute chart. There's that comparable uptrend line. There was a minor trend line there, and there was nice price support right there. I pointed out it's 25,673. So you've had numerous opportunities so far. If you were looking to buy, get back in, or get into silver to begin with, or cover a short, right here. That's and that. Again, I think that's probably going to be it. And you can see there's also, I need to add this right now, there's some price resistance above there. If we break it, we could run. Why is that resistance? Because you had a reaction high here, a distinct one here. It's scary. It looks like a little head and shoulders. Those usually you want to see them on longer term time frames, but a lot of traders trade them. They almost become a self-fulfilling prophecy. Traders see them on the short-term charts. So what I'm drawing here, that is support. Whether it's a neckline for a head and shoulders pattern or not, I mean, that certainly takes the form of one. Let me turn on volume. A lot of people don't do this. One of the criteria of a head and shoulders pattern is you want to see, you confirm it with volume. You want to see increasing volume on the formation off the head, the drop down from the head, which you did there, and then you also want to see it on the drop down off the right shoulder, but you didn't really see much there. There was a little spike there. But again, that doesn't matter. That's support. It's the same difference. You break it. If you believe the head and shoulders are going to play out, then basically what you do there is you have a measured target, which is just the distance, which I'm drawing a trend line from the widest point from the top of the head down to the neckline, and then you add that to where it breaks down. So let's say it broke down right here, then that's going to be your target for gold, and that's certainly a possibility, and you can use this. I'm going to put a support level there because I see price support as well. So I didn't just randomly. I always take measured targets on my chart patterns that I recognize, and then I'll look for the nearest decent support or resistance level. If that it happens to be perfect, right down to that nice support level right here, you can see all these reactions there. But had it fallen, let's say a little shy, or especially gone a little over it, and let's say I were to trade that and short a breakdown of the neckline, and the measured target was down here, I would cover here. I always put the higher weighting on support level than I do these measured targets. They're just rough guides, but I'll tell you, it's amazing how often they're pretty darn accurate. Head and shoulders, wedges, all kinds of chart patterns. And anywho, that's that. And you also have, again, uptrend line support. So it's the same story on silver. If you break that, you have trend line support. So therefore, if everyone, silver bears are looking at this and they short it there, they could get smoked if you hit the trend line and bounce and then come back up, because at that point it would be a failed breakout. So either way, those are the levels to watch, and trade accordingly. That's again $24 is roughly the next big support level and measure target. If that happens to be a head and shoulders, it's going to play out. If it did, most likely this is probably going to coincide with a rally in the stock market next week, with the recent lows holding, or maybe a little fake out move down below there, followed by a big reversal, keeping those bullish divergences on the daily time frame intact. You would see the flight to safety bid come quickly out of gold and silver. So that would be that scenario. That's not my preferred scenario, but again, I'm flexible. If it looks like that's what's happening, even if I don't get the perfect entry, I might be in that or out of my silver positions, just as an active trader. But right now, again, long-term charts to me are nothing but bullish on gold and silver. Let me make that clear. I'm kind of speaking toward the more active trader right now, and you can see that trading range in there. pretty nice. But and then of course a breakout above it, 26,382. Boom, that would pop. And if we run up again, we'll probably just take out those highs. We could have another reaction on them, but I think if we can pop this, we're probably going to run. And this, by the way, meshes with my preferred scenario, which is the stock market craps out next week, breaks the recent lows and runs down and probably hits my targets if I'm right next week. And let me just get back to that, and then we'll wrap the video up. I just wanted to quantify how much that would be. If so, we're at 328 right now. If my first target's hit, you have a drop of about 9% on QQQ. On IWM, you'd have a drop. If that target is hit, you have a drop of about 14% before my next swing target. And yeah, those don't align percentage-wise, and nor did these indexes always move the same. But again, this is where I'll up the frequency of my updates and kind of give you my thoughts. Let's say QQQ hits. Do we reverse it, cover, or do I reverse it and cover, trade a bounce? If IWM's here, and then what I do with IWM? There's really no support in the middle there for IWM. So I'm really, as a trend trader, and I have positions in longer term counts that I don't, micromanage like I do in my active trading account. That means day in, day out, little 5-minute chart stuff. That doesn't, and on those, that's what I'm holding out for. I have my eye on the prize on IWM, and where do I start to stop out? As I've told you before, solid break over there, and really these moving averages, especially on SPY and QQQ as well, the 200-day / 40-week moving averages, that's where I start to say, wow, you know what, maybe it was a correction that's over, and we're going to go up now. So as of now, that's not the case. So as long as we remain under those key 40-week moving averages, especially on the big caps, there they are up here on SPY and QQQ. Right there's your 40 weeks, and then the big levels are where we broke down. That's really kind of, if there's a line in the sand, that would be at about 380 on QQQ and about 451 on SPY. All right, so let's see where we close the week. And again, if we get another red candle, it keeps the potential or the possibility that this bear flag's still in play and may have more to come, because there's our measured target right there. Remember, the measured target on the bear flag on SPY comes in a little bit above that. And I could make a case. There's a candle right there, a weekly candle, and that's 400. So if you're a SPY trader or ES, 400, you can either cover or at that point start trailing tight, run some tight stops. They don't have to trail down. You could just place a tight stop and manually ratchet down or trail it down. And what I think will happen if my second targets are hit and it happens in that waterfall type selling next week, we'll probably overshoot. It's usually what you do, those support levels, and then close back on them by the end of the week. You overshoot them for a day or two is usually common. So that's the benefit sometimes of either in a strong move, trailing a stop down and letting it run a little bit, because who knows, we could shoot right through my second, again, that was my near-term second target and then long-term first target. This is how I resequenced the targets for you recently. I think I did that last week, shared that with you. And then on QQQ, remember, I've been pretty consistent on having multiple targets, a total of 4. First one already being hit, T2, T3, depending where that trend line comes in, and T4, about 235, and or that blue trend line there. All right, guys, let me wrap it up here, get it out to you. Crude's up today, and what else did I mention? That's it. I wanted to keep this one limited to the stock. Oh, I told you bonds. Yeah, didn't I? All right, sorry about that. Then we'll wrap it up. Treasury bonds. Look at the long bond first. ZB. There it is. This is a 3-month chart. I did an extensive video yesterday, so I'm not going to go into a lot of detail. I just want to point out the most important features. We have a nice divergent low there in the 30-year bond. We took out this trend line here. We back tested it once. We're there again if we can get above it. But on the flip side, we also have this trend line here that's been taken out. And again, it's these divergences that I like bonds right now. This also, by the way, guys, would coincide with my preferred scenario that the market drops pretty hard next week, and that should give us a rally in bonds because they are the king of flight to safety. Gold's number 2. Gold, let's call it the queen. This is the king of flight to safety assets. Always has been, probably will be. until the dollar is so worthless you use it as toilet paper, and a lot of people think that day is coming sooner than later. But as of now, the dollar still reigns king, and then institutions really have nowhere to go. You can't put it in crypto right now. The crypto is just too risky. Gold's getting its fair share of a bid, and so this is it. Here's ZN. I told you I like ZN as well. That's the 10-year bond futures. IEF is a comparable ETF. There's a trend line, so we just need to pop that trend line, and then if we can go in and take out that, regain that trend line, that'll be this whole thing, just like on ZB, will have proved to have been a false breakdown, aka bear trap, and you'd have a short squeeze in treasuries. And again, that would, especially if we get a nice sell-off in the stock market, you get a flight to safety bid, and it's twofold. It's not just the traditional flight to safety bid. It is also what I talked about. Bonds go up because long-term rates fall. We know the Fed's bringing the short end of the curve up. That's a guarantee. I think he's doing it way too slow, but again, whatever, we know it's going up. It's just a matter of how much after this next meeting. But then what's going to happen is long-term rates are not controlled directly by the Fed. They can try, they can put pressure on it, they can buy bonds, they can buy trillions of dollars of bonds, although they're unwinding that now. But what happens is if the stock market drops, future growth expectations are going to drop because the wealth effect is going to take a hit. Consumer confidence came in today. It was at 10 o'clock. They announced it. It came in at the low end of the range. Consumer confidence continues to plunge. How can it not with this inflation that we have going on right now and the stock market being down? So where I'm going with this is, yeah, short-term rates go up, but if I'm right and the stock market continues to fall, future growth expectations are going to fall, therefore long-term rate expectations. It's kind of an offset. What's going to weigh out more, the inflation and I think at this point in time at least it'll be the expectation, because the market's going down and you'll see long-term rates go down. And remember, bond interest rates and bond prices move inversely. So that's kind of where fundamentals mesh with technicals. That's what I like to do sometimes. Talk about fundamentals, and that's just, look, a scenario, and whether it plays out for the reasons I just said or not, that doesn't matter. Trade off the charts. Warren Buffett invests on fundamentals, and he's great at what he does, but he buys things and he'll take a huge bath on them if he gets in a year early. He's looking out 5+ years. Me, I don't have 5 years on my, when I'm trading on, leverage and, trying to game in and outs of the market. I'm looking to make profits today, tomorrow, next week, next month. And so, and that's why I'm on these hourly charts, and Buffett's not trading hourly. So well, first of all, he's not trading technical analysis. He's using fundamental analysis. All right, let me wrap it up here. I'll get the video out to you guys. This has been Randy Finney with Right Side of the Chart, and have a great day.